All right, let's talk about something we've probably all felt. You look at your savings account, you see a nice little chunk of money sitting there, and you get this nagging feeling. I should really be doing something with this. If that sounds familiar, you are in exactly the right place.
You know, that feeling usually comes with a bunch of other questions, right? Like, what if I invest and the market crashes tomorrow? Or what if I pick the absolute wrong thing and lose everything? Or maybe you're thinking, is $5,000 even enough to make a difference? And look, those are totally normal fears, but they're the kind of thing that keeps so many people stuck on the sidelines. So in the next few minutes, we're gonna tackle those questions head on. We're gonna build a really clear plan that can take a single one-time investment of $5,000 and over time, grow it into something absolutely life-changing. Let's get into it. Okay, first things first, we've got to cut through all the confusing jargon the financial world loves to use. The single most important tool we're gonna use today is something called an ETF.
So what is it? Honestly, the best way to think of an ETF is just as a shopping basket. Instead of trying to find the one single company that's going to be a winner, you just buy the whole basket. And with one click, you own a tiny piece of hundreds, sometimes even thousands of different companies. It's instant diversification made super, super easy.
So you might be wondering, how is this different from other stuff I've heard about? Well, buying a single stock is like putting all your money on one horse to win the race. It's super high risk, but also, high reward. On the other end, you've got mutual funds. They're also a basket of stocks, but they come with a manager who's actively picking and choosing for you and charging you a pretty hefty fee for the privilege, whether they do a good job or not.
And this right here is why ETFs are such a game changer. Just like a mutual fund, it's a basket. But here's the key, it's passive. It's not trying to outsmart the market. It's just designed to track a market index, like the S&P 500. And because there's no expensive manager making calls, the fees are incredibly, incredibly low. You get all that diversification without the high cost.
So how do you find one of these great ETFs? It's not about some complex secret formula. It's actually way simpler. We just need to follow 3 golden rules, a little framework that cuts through all the noise and helps us focus on what really matters. Rule number 1 is all about cost. You have to check something called the expense ratio. That's the annual fee. A good, solid index ETF will have a fee as low as 0.03%. It's so low, it's practically nothing. Now compare that with a typical mutual fund, which might charge 1.5%. Now that doesn't sound like a big difference, right? But do the math. It is 50 times higher. Over 30 years, that tiny little difference can cost you tens, even hundreds of thousands of dollars. So, rule 1, keep your fees rock bottom. Rule number 2, you've got to know what you actually own. You can't just go by the name of the fund. You need to look under the hood. What's actually in the basket? Is it all tech companies? Is it companies from all over the world? If you don't know what's inside, you won't understand why your investment goes up or down. And that's when people panic and sell at the worst possible time. And finally, rule number 3, we want a proven track record. And I'm not talking about whatever was hot last year. I mean true resilience. Has this fund been through the ringer? Did it survive the dot-com bust, the 2008 financial crisis, the 2020 crash, and bounce back stronger every single time? That's what shows you it's built to last. Okay, so with those 3 rules in our back pocket, let's get out of the theory and get practical. We're gonna build our very first portfolio. We'll call it the starter plan, and it uses 3 fantastic ETFs that pass all our tests with flying colors. Here are our 3 picks, and each one has a very specific job to do. First up is VOO. This is our rock, our foundation. It tracks the 500 largest, most stable companies in the US. Then we have QQQ. Think of this as our accelerator. It's focused on the 100 biggest, most innovative tech companies. And finally, we've got VXUS for balance. This gives us a piece of over 8,000 companies from all around the rest of the world. So, how do we split our $5,000? Well, the logic is pretty straightforward. We'll put half of it, 50%, into VOO for that solid, stable base. Then 30% goes into QQQ for that extra growth potential. And the final 20% goes into VXUS, just to make sure we're not putting all our eggs in the US basket. It's simple, it's balanced, and it's ready to go. All right, now for the part that so many guides just skip over. How do you, actually buy this stuff? I promise you, it's probably way easier than you think. We can break it all down into 3 simple steps. First, you open a brokerage account online.
Big names like Fidelity, Schwab, Vanguard, it takes like 10 minutes, seriously. Second, you just transfer your $5,000 from your bank account, just like paying a bill. And third, you literally just type in the tickers, VOO, QQQ, VXUS, enter how much you want to buy of each, and click confirm. If you can order a pizza online, you have all the skills you need to do this.
And these days, brokerages make it so easy. There are no minimums to get started, no monthly fees. But here is the absolute game changer, the one button you have to click. Turn on automatic dividend reinvestment. That means any money your investments earn automatically buys you more shares. It's the secret engine of compounding, and you just have to set it once. Okay, so we've built the portfolio, we know how to buy it, so now what? Well, this is where the real magic happens, and it's all powered by the surprisingly effective strategy of doing pretty much nothing at all. Just look at this. After 1 year, the growth is fine, but compounding is like a snowball rolling downhill. It needs time to build momentum. By year 10, your $5,000 is getting close to $20,000. By year 20, wow, it's over $70,000. And by year 30, that one-time $5,000 investment has morphed into over $268,000, all while you just let it do its thing.
Now, that is a fantastic outcome. But what if you have a really long time to invest? Or you're just okay with a bumpier ride for a potentially bigger prize? Well, we can make 2 simple tweaks to create what we'll call an aggressive growth portfolio. Here's what we do. We swap out that international fund for VGT, which is a laser-focused bet on US technology companies. Then we just tweak the percentages, putting less in our stable base and more into our growth engines. Now you have to be ready for this. A portfolio like this can fly high, but it can also drop hard and fast. This is not for the faint of heart. So what does that extra risk get you? Let's look at the difference. 30 years later, our solid starter portfolio is sitting at nearly $270,000. Awesome. But the aggressive growth portfolio? It's sitting at over $640,000. It is an absolutely incredible difference from just 2 small changes.
I mean, just think about that. The gap between them is over $370,000. It came from the exact same $5,000 over the exact same timeline with the exact same one-time investment. The only thing that changed was the amount of risk and volatility we're willing to accept along the way. And look, there's no right or wrong answer here. One plan is not better than the other. They're just different tools for different goals and different people. The most important step by far is just getting started. So the only real question left is, what is your 30-year journey going to look like?